Hey, what's up, everyone? I'm David Greene. This is the David Greene Show under Real Talk Real Estate, coming live for everybody on YouTube to talk about the condition of the housing market. It's a little different. Every day I'm seeing different things. So in today's show, we're going to be talking about international real estate, who's doing well, who's hurting, and local real estate, what's happening nationally, what cities and areas are likely to have some struggles coming up, as well as which areas we think are going to be where people move to that are going to do well. And then how much of this is seasonal? Are things going to pick up coming into the season? We're also going to touch on interest rates a little bit. So if you're interested in real estate, the economy, wealth building, and you're trying to figure out where to move your money, where opportunities might be, and what you should do, you found the right place. Before we get into it, please take a minute to subscribe to the channel. All you got to do is hit that little subscribe button. Make sure you like the video and share it with somebody else. And as always, I read your comments and I try to respond to them. So let me know what you're thinking as we get into today's episode. All right. The first news article that I have has to do with inflation and consumer confidence. Now, this comes out of realtor.com. It says inflation ticks up and consumer confidence falls. Economic uncertainty has kept mortgage rates steady. Inflation continues to be a thorn in the economy's side, and data suggests growing concern from consumers and businesses about the impact of tariffs on the broader economy. On Friday, the PCE, which is the Fed's preferred inflation gauge, that's got to be consumer index, I would think. I got to look into that. Was steady at an above target pace, and the core measured received an uptick. This contrasts a bit with recent trends in consumer price index data, which had shown some progress. Consumer confidence also fell overall, driven largely by falling expectations about the next 6 months, which dropped to a 12-year low. That part probably has to do with the tariff talk. People are expecting higher prices, and they're assuming that that could put us into a recession. Uncertainty about what's ahead has kept longer-term rates relatively steady in the past month, and mortgage rates have followed suit. They dropped 2 basis points this week, continuing to hover in the 6.6 to 6.7% range. While mortgage rates are not low, they are lower than they have been, and this likely helped push both new home sales and pending home sales higher month to month. All right. We won't take too much time on this, but if you think that mortgage rates are affected by the Fed putting rates up and down, they are affected by it, but it's more indirectly. Jerome Powell and the Fed are not determining mortgage rates. They're determining what's called the prime rate, which is the rate that banks charge each other when they want to borrow money from each other. Mortgage rates, shockingly, are actually a product of supply and demand, just like everything else is. So I can, to put it simply, so we don't take too much time on this video, when there's a lot of people that want to buy mortgages and they want to buy them compared to other things that they could buy. So when they think that, man, people are going to make their payments and I'm going to get a really good interest rate here, the banks can charge more. When there's not a lot of people that want to buy mortgages, then I'm sorry, let me say that again. When there's not a lot of people that want to take out mortgages, banks have to lower them in order to get people to take out a mortgage, which means that there's less people that want to buy them because it's a lower rate. And so there's this balance between, hey, how many lenders are out here buying our mortgages once we give them to the person listening to this? And how many people listening to this are actually wanting to get a mortgage? Because if you're having a hard time selling them and you put your rates too high, people just don't take mortgages out at all. But if you're putting rates too low and everybody goes and gets a mortgage, there's no one to buy the mortgages after they've been sold, or you sell them for such a cheap price that the banks don't make any money. So mortgage rates themselves are a product of supply and demand, just like everything else. Looking year over year, however, we see that new home sales are up while pending home sales are down, highlighting the new homes market. The new home market's continued advantages, especially when builders are flexible on price and can offer lower rate financing. So this tells us that more people are buying new home construction than buying existing homes. So if you're somebody who's shopping for a home, you might be seeing this, that you think you're going to get a better deal from the builder than somebody that already owns the home. For a long time, that wasn't the case. People were buying the existing homes because they typically are built in the better areas. Now, one exception to this would be if the market that you're looking to buy in, it's like a lot of people are moving there. It's not an established market. So if you're in the new hot place, like let's say you're going to Tampa, there may be a lot of builders in Tampa Bay that are building homes because that's a growing area. If you're looking to move to San Francisco, San Jose, San Diego, one of these existing established areas, there isn't really new area to build new homes. So when you buy a new home in a place like that, you're getting a worse location because the best locations get built out first. I think this is one of the things when you see new home construction is selling faster, it's an indication that people are moving to areas that were previously not as popular or not as habited as the place that they're moving to. All right, our next article is about Maui. I've got a couple properties in Maui. My best friend, Brandon Turner, you guys probably know Brandon. He lives there. Got me and a bunch of other people interested. And this is about Maui's latest real estate market demonstrates economic challenges. So this is bad news for people like me that own property there and other investors and you're going to see a trend in today's video where we talk about how the markets that were hottest are the ones cooling off the most. That's the best way to put it. According to the latest reports from Realtors Association of Maui, the housing market experienced mixed trends in December, seeing a decrease in single-family home sales that were offset by a significant rise in median prices. The median sales price for a single-family home increased by 14.5% compared to the same time the prior year, reaching $1.374 million. At the same time, condo sales dropped by 43.6%, with the median sales price increasing by about 1.2%. So even though prices are going up, the number of these things that are selling is like way down, 43.6. You're close to half as many units selling as you had before. Michelle Del Rosario of Maui and Company Real Estate said she looked at the pending sales on Monday and saw they were at 193. It's going down, not up, by 50 units. Now, 50, you have to take that in comparison to the 193. So if we bump that up to 200, it's basically down by 50, which is 25%. So it's down by a little bit more than 25%. This is a very big number, folks. That shows that there's not people buying a lot of at least condos in Maui. She said that there are a variety of issues contributing to the disruption of the market, from people choosing to leave Maui and Hawaii altogether to employers not paying high enough wages. Del Rosario said, now is the time to help Maui's economy. People need jobs that they can qualify for a mortgage. We need a stronger economy so that families have the ability to save, have reasonable rent, save money, and be able to buy a home. She also said that people aren't buying as quickly. The days on the market are longer and more affordable housing is needed. The more affordable or workforce housing that's built, the more opportunities there will be. According to the latest statistics, overall in December, the number of sales for single-family homes was at 56, down 1 from the previous year. The number of condominium resales was 53, down 93 from December of 2023. RAM President Lynette Pendergast said in a news release that the data show the potential and challenges facing the current market as we enter 2025. It's essential to focus on creating a sustainable housing market that supports Maui's residents and adapts to the island's evolving needs. Blah, blah, blah. This is the typical realtor speak that everybody talks about. They point the finger and they blame other people. What can we take from this article right here? There's not a lot of people buying real estate in Maui and overall in Hawaii. Why do you think that might be? Tell me in the comments, what do you think is the reason that you don't have a lot of people buying real estate in Maui, for one? Kevin Hawthorne says, good evening from Lakeland, Florida. What's going on, Kevin? That's an area actually right near Tampa Bay that I just mentioned, kind of between Tampa Bay and Orlando. My take would be Hawaii is expensive, and you may see a trend of all the places that we talk about that are struggling are more expensive, and the places that are doing well might be the opposite of that. Let's see what else we got here. More news. This one's international. Real estate once drove China's economic growth, but now it's holding it back. China has gluts of tens of millions of unoccupied housing units, many unfinished and unsold. An inescapable part of the landscape seen from roads or trains are compounds of hulking, empty, high-rise buildings. Many of these ghost cities, as they're often called, have no lights and see-through quality due to their unfinished open windows. The country's 3-year housing market collapse has dealt a devastating blow to the wealth and confidence of Chinese households. It continues to be a huge damper on growth in the world's second largest economy. But that could be about to change. Beijing has recently signaled that it's prepared to take bolder steps to stabilize the housing market and boost overall economic growth. Late last month, the government announced plans to cut mortgage rates and lower home down payments, leading to an early October jump in new home sales in Beijing, Guangzhou, Shenzhen, and Shanghai. And for the first time, China's top leaders stressed that they must stop the decline and return to stability to the real estate market. According to a statement following the September 26th meeting of the Communist Party's ruling Politburo, Last week, the finance minister pledged to shore up big banks and local governments with fresh funds, while a top economic planner projected the country will meet its growth target of around 5% a year. Experts say it's not clear whether Beijing will unleash the massive monetary and fiscal stimulus needed to rebuild confidence in the economy. Any such plan would require approval by the Legislative Standing Committee in coming weeks. But many agree that the property market holds the key to a meaningful recovery. Property is definitely the biggest drag on the economy, not just this year, but over the past 3 years, said Chief China economist Larry Hu. The current property downturn could easily drag China's GDP growth down by 2 percentage points. But if we have property stabilized, then the Chinese economy could easily grow 5 or 6%. That's a huge difference. Beijing's concerns over the highly indebted property sector led it to impose a regulatory crackdown in August of 2020 that restricted new borrowing by developers. This triggered a downward spiral as developers were unable to complete housing and they began defaulting on their debt. This is why you heard so many stories in China of unfinished developments, condominiums, apartment buildings that were halfway built and just left there because apparently China said, hey, we're not letting borrowers borrow more or builders borrow more money. So they ran out of money to complete their projects, which sort of stalled the Chinese real estate market. Now, if you're somebody who worries about the war with China, all the talk that's going on, you might feel a little bit better to know that we're not the only country that it seems to be sinking into recession. Our real estate's not flying off the shelves like it was before. China's is too. Now, I'm no global economist here, but I would wonder, is all the talk that we hear of trade wars with China and tariffs and them cutting off the supply line of stuff that they ship here and potential war with Russia and Ukraine and US getting involved, do you think that the Chinese populace might be thinking the same thing as the American populace, that I don't want to buy a house right now because I don't know what's going to happen? This is what I mention a lot, that the velocity of money determines the wealth of nations. When money changes hands, everybody makes money. Well, nobody wants to let go of their money and buy something if they don't think money's coming back to them. And when you think about going to war, everybody wants to hoard. So what happens is money stops changing hands and you almost get a self-induced economic recession whenever there's talks of war or rumors of war. So it appears that the same thing is happening in China right now. This is not just an American issue. All right. Our next article is going to be similar to that one. And this has to do with China's retail market. The November retail sales miss expectation as real estate slump deepens. This one comes out of CNBC. China's retail sales disappointed in November as sentiment in the real estate market weakened further, in another sign that Beijing's efforts to boost the economy have failed to revive sluggish demand. This marked a sharp slowdown from 4.8% growth in the previous month. Retail sales in October had recorded the quickest growth since February, helped by the annual Singles Day shopping festival that kicked off more than a week earlier. If you're somebody that would be participating in Singles Day, let me know in the comments. Maybe we can get a David Greene show dating pool going on, and we can take people that like real estate and connect them. Unfortunately, I probably have 4% female audience at this point. So, gentlemen, you might have a bit of competition there. The stimulus effect has been short-lived, said Mai Bui, economist at investment management firm AMP, in an email. While the recent fragile but upward momentum in Chinese economic data will translate into real GDP growth rate of 5% this year, they are unlikely to turn around weak consumption sentiment due to falling home prices. So what this person is saying is, in China, when people see the housing market go down, they probably are feeling like, hey, I don't have as much wealth, my net worth is decreasing, and I don't feel secure because my property is losing value. They don't want to spend money. Same thing as what we're talking about here. So this shows that China may be in a similar situation to America, which makes me wonder about the fact that we tend to both countries sort of prospered at the same time, and now they're both receiving some bad news and economic challenges at the same time. Could it be that we're linked together? Maybe because they produce a bunch of stuff and we buy all that stuff. So if we stop buying as much stuff here because we don't think we have as much money, the people in China don't have as much money coming in and they don't have as much economic certainty. They don't have as much demand for housing. So their home prices don't keep going up. Probably something there. Let me know in the comments what you guys think about this. The next article is about Russia. Russia's the real estate market rocked by the end of generous mortgage subsidies. The Russian real estate market is being rocked by the end of the generous mortgage subsidy program that has been running for years and was used by the Kremlin to stimulate the economy since the start of the sanctions regime. If I read this entire thing in a Russian accent, it would sound like I was playing the villain in a real estate movie. In July, the government ended the scheme that kept mortgage rates at 8% since its intro in 2020, at a time when the Russian central bank's prime rate had climbed to 19% and was expected to rise further. The low borrowing rates caused a boom in the real estate and construction sector that helped maintain employment and boosted economic growth, which became even more important after the West imposed the extreme sanctions regime on Russia following the invasion of Ukraine. So they stimulated their economy by lowering interest rates, made people feel wealthy. Then they invaded Ukraine in 2022, and we in the West imposed extreme sanctions against them, which hurt their economic development. However, the booming housing market also contributed to rising inflation, which peaked at over 9.1% in July. So that's another thing that we have in common with Russia. We are seeing inflation. They are too. We stimulated our economy by increasing the money supply. They stimulated their economy by lowering interest rates. We both have inflation. Nevertheless, the CBR is widely expected to hike rates by another 100 basis points at the next monetary policy meeting at the end of October. What that tells you is that they see that there's an inflation problem, so they are going to raise interest rates by 100 basis points, or that's basically 1% if you don't live in the mortgage world like we do at the OneBrokerage. And that's what conventional wisdom tells people will stop inflation. I don't tend to think it's as effective as people think, but I know why they do it. As inflation is not being driven by traditional money supply problems, but rather by heavy military spending that has been overheating the economy, the CBR teamed up with the government to introduce non-monetary policy methods to cool the economy. Starting with ending the mortgage subsidy in a major change of direction, the regulator has switched from policies to support growth in the face of sanctions to tackling head-on the high inflation rates, which have become a major headache. As a result of this change in a pessimistic medium-term forecast, the CBR predicted that both growth and consumption will fall sharply in 2025. This is our Russian counterparts here. Russia's real estate market is undergoing a significant upheaval as a result of the changes. After an initial rush to sign up for the program before the expiration deadline, mortgage issues halved in July as borrowing costs jumped. So they issued half as many mortgages in Russia when their interest rates went up. Construction companies stepped into the breach to soften the blow by offering their own flexible subsidies with schemes similar to the subprime deals in the U.S. This means the construction companies building the houses are offering subprime loans to people to get them to buy it, which created a ticking time bomb for us. Might be the same thing in Mother Russia. Preferential rates for the early stage of the loan that increase to market rates after a few years on the assumption that rates will fall in the future. However, analysts point out that if the rates don't fall, then the companies are setting themselves up for a major financial crisis several years down the road. That was what happened to us. We kept rates very low for a short period of time in 2005. So you got a 30-year loan, but it wasn't a fixed rate. You got a great interest rate in year one, a pretty good one in year two, a solid one in year three. And then in year 4 or 5, it jumped to whatever like a much higher rate was, and nobody could afford the house. And so everybody put their house on the market at the same time to sell it. Nobody was buying, everybody was selling, created too much supply, not enough demand. Boom, we have a crash. Russia sounds like they're doing the same thing. They didn't learn from us Americans. If you're somebody who's been worried about a war with Russia, just like you may have been worried about a war with China, I'm bringing in these 2 articles to maybe give you a little opportunity to exhale here. They're not doing so great. Their economies are not cranking along. In fact, Russia might be setting themselves up to have a really big problem in a couple years because they feel like their economy needs to be strong right now, probably because they need the money for their military. So again, take heart, my dear real talkers. It is not just America that is struggling right now. It's a lot of the country. And now we're going to be talking about some of the markets within America that are struggling more. And we're going to look for the pattern of why that might be. I've kind of alluded to it already or discussed it in the video. Christoph says, why are we talking about the China market? How does this help us? And Kevin Arcio says, what's the mortgage interest rate in Russia? Well, I would think that if we go to war with China, or if the Chinese economy does poorly, that has a very big impact on us. You know what? This is a great opportunity for me to bring up a recent Instagram post that I put out. It was very controversial, but didn't need to be. I basically described if we get auto tariffs put in place, here's what will probably happen. This will be easier. This will be harder. This will be better. This will be worse. This will be more money. This will be less money. And I talked about the trade-offs. And much like the Joker, everybody lost their minds. They were just going nuts in the comment section. So follow me at David Greene 24 on Instagram and go check out that post. The trend that I noticed, in fact, this is also a good time to plug my new book, Better Than Cash Flow, The 10 Ways You Make Money in Real Estate, available in paperback now, not just Kindle. The book talks about how to analyze real estate holistically. There's like 10 ways that you can make money in real estate. How do you put all 10 of those into your deal and maximize them, as opposed to what most people look at, which is just natural cash flow? What is it going to cash flow if I buy it right now? I don't care about the rest. You should really look at all of it. A lot of people look at the world, their relationships, and our government the same way. They're like, hey, just tell me where to buy. Tell me what everyone else is doing. I just want to go do it. I don't care how we got there. I don't want to hear about what might happen or what if something changes. I'm lazy and I want a shortcut. So why do I care about what's happening in China? Well, like I said earlier, China's economy and our economy are very closely tied together. We print dollars and send them to countries like China, and then China makes goods and sends them to us. And companies like Amazon has made that relationship that much tighter. Now there's a connection, just like Airbnb connected people that travel with property owners instead of hotels. Amazon connected China and America, and maybe China and a bunch of other countries, because they make cheap stuff there and everyone buys it. Well, if we put tariffs in place and we buy less Chinese things, or if our country goes into a recession, we buy less things altogether, that's less money going to China. That's going to hurt their economy. That's going to hurt their real estate. That's going to make their people feel less wealthy. That's going to put pressure on their government to do something and hopefully take their attention off of us. It also means you're going to have less cheap products coming into America. So I think that has a lot to do with us. It just doesn't directly tell you in a 30-second video where you should go buy, but we are going to be getting into that. Steve M says, David, what's your biggest fear for the California housing market? I'll get to that in a minute. Before I do, Varapa T. says, David, you're one of the best at real estate. Thank you for sharing your knowledge and keeping us updated. Appreciate that. Please share the video with somebody else if you guys know. Okay, what's my biggest fear for the California housing market? My biggest fear is that you don't have a middle class. You have very wealthy people that live in California and they can afford the 13.5% state income tax. They can afford the high sales taxes. They can afford the high gas prices. Because when you're super wealthy, even if though gas is double what it costs in other states, it represents such a tiny portion of your budget that even though it doubles, it doesn't affect you. If you're not super wealthy, how much you spend on gas and energy and transportation makes up a very big portion of your budget. So energy costs going higher, your PG&E bill going up, your gasoline becoming more expensive, that actually makes you significantly worse off. You become more poor, and it gets harder and harder to make ends meet. And then those people leave California, which make up a lot of the labor that we need, or they stay there and they just got a government assistance. And so what happens is you get the crazy wealthy and the very poor. What I prefer to see is that come together a whole lot more. So instead of this like curve of a lot of wealthy people and a lot of poor people, you crunch more of them in the middle, and you have kind of like the hourglass figure. I guess that would be the opposite of the hourglass figure, right? Like you have a big chunky middle class, not that many people on the top and not that many people on the bottom. My fear is California is slipping into that. And if it slips too far, you end up with more people that are hopeless and in despair and have given up and they're not trying. And they keep voting for politicians to give them money, but the money comes from the rich people. And if the rich people all leave California because you took too much of their money, there is no money to take to give to the people that are voting for free things. And now you implode. That's the worst case scenario of what I'm worried could happen in California. I don't think that they're going to have that happen right now, but I think that's what we should be worried about when we continue to have politicians in place, like in California, that just keep saying, tax the rich, tax the rich, tax the rich. Eventually, the rich say, I'm leaving, so you can't tax me. Or, you know what, I'm not going to work either, so you can go figure it out. And then everybody's poor. All right. A little bit of good news here. Let's talk about a market that's doing well right now. The Alabama real estate market thrives amid economic shifts. This is what I wanted to get to. I gave you guys some of the rough markets, China, Russia, Maui, California. Now we're talking about Birmingham, Alabama, which I can't say I ever thought I would, unless I was talking to Charles Barkley. I never thought Alabama would even come up. Freaking Bama. The Alabama real estate market is showing promising numbers as inflation and high interest rates continue to fall. According to the Alabama Association of Realtors, the old AAR, the state saw more than 50,000 home sales in November, an increase of almost 6% month over month, but a 2.5% decrease from last year. However, that's not necessarily bad news. Since 2023, the median sales price of homes in Alabama has increased by around 6,000 or almost 3%. With the average sales price increasing, the state's real estate market is seeing a lot of money flowing between buyers and sellers, more than 1.2 billion. Remember I talked about how money changing hands is what creates wealth, not just the price of something? Because if something costs a lot of money, but nobody buys it, no one benefits. The seller doesn't make any money and the buyer doesn't get a new thing, and the buyer can't get future appreciation either. It's every time something changes hands that a whole bunch of middlemen get a tiny little piece of that transaction for the role they played. That becomes income for a whole bunch of people, and you get a healthier economy. The money being exchanged occurs as the state experiences a surge in housing availability with more than 19,000 homes for sale in November, marking a 28%. Ooh, my screen just moved. Or just over 4,200 increase compared to 2023. According to the AAR, the increase in available homes gives buyers more choices and flexibility in finding a home that meets their needs. Folks, if I'm looking for a market that I want to like sell homes in or live in or invest in, it looks like that. I want a whole bunch of movement. I don't necessarily need incredibly expensive homes that no one's buying. If you have LA mansions that no one's buying because of the mansion tax is so expensive that nobody puts them on the market, or nobody wants to buy it because they don't want to pay the tax when they sell it, doesn't do any good. Your Zestimate can be really high if there's nobody to buy that house. How does that benefit you? The healthy economies see a lot of movement, and Alabama seems to be so. Now, I am not God. I don't know why Alabama market is doing good. All I can do is sort of share with you all why I think this is going on. And then what I like to do is I share my logic, so that if you disagree with me, at least you see the logic I used to get there, and you can apply that logic in a different way. Or you can say, yeah, this is why I do or don't agree with David, because he showed his work, basically. I think the reason that Alabama real estate in this case is doing well is because it is cheap. It's in the South. People are moving there, jobs are moving there, and you have a chance to freaking make it as a regular blue collar person. You don't need to have an incredibly high paying job to be able to own a home. Now, is your home going to be gorgeous on a hill overlooking the bay on a huge lot with upgrades everywhere and vaulted ceilings? No, it's going to be a modest home, but you know what? That's okay. It is totally fine to have a regular 2-3 bedroom house with 1 or 2 bathrooms that is your own, that you make the mortgage payment on, that you pay off over time, that you improve, that you put in new flooring or you go paint it. You do stuff to improve your own property. That is what I wish America was. Not a whole bunch of people owning all the houses and then a bunch of other bitter people complaining about it and renting, but a much bigger chunk of people owning homes. Now, I'm saying this because I'm afraid that the hedge funds are going to go in and Blackstone's going to scoop them all up. And then there's going to be nothing to buy. Lack of inventory makes prices go up. So I'd love to see more people moving into that area. Industry hit that area. In areas that were previously impoverished, to be frank, get capital flowing into them and the quality of life rising for everybody. Better schools, better streets, less crime, more opportunity, more hope. This isn't about real estate, but I think it affects real estate. When you lose hope, your life sucks. There's not much you can do. I mean, if you just think about why the spirit of despair is so heavy and powerful, because when you feel like why trying, there's no reason to fight, you won't fight the spirit of despair. It's like the perfect tool that the enemy can use. If you feel like it's hopeless and why try, you're not even going to fight against the spirit that's telling you that. When you have ambition and you're like, man, I want more. I want a better life. I want to help more people. I want to see what I have inside, what my God-given talents are. The spirit of despair is tough to get you down. But when you don't have that, man, it's like you got no hope at all. And a lot of parts of the country just have that feeling where there is no opportunity, there's no chance. And what we do is we just spend our time pointing fingers at everyone for why that is. That's what the spirit of despair does. It gets you to look at everybody else and say why it's their fault and you're in this position because of them, and then they do the same thing back, you're in this position and I have nothing to do with it, and nobody gets anything done that's productive or helpful. I want to see that change. And I don't want to see all the wealth congregated in areas like San Francisco and San Diego and San Jose, like I mentioned earlier. I want to see a lot of those jobs spread into these areas, money pour into those infrastructures, and people get more opportunities. Okay. Last article here. Housing market predictions after the latest U.S. jobs report. There's a strong correlation between the housing and the job markets. This is for the gentleman that said, why are we talking about China? Because China affects our job market quite a bit. Lower unemployment rates are generally linked to an increase in housing demand as workers have more home buying power. While the U.S. job market has been strong in the past few years and unemployment low, home prices appreciated faster than wages, which erodes Americans' purchasing power. That is a great point. When home prices go up faster than you get a wage increase, you become more poor and housing becomes less affordable. In January, the economy added 143,000 jobs, according to the latest BLS data, slightly below the experts' expectations of around an additional 170,000 jobs. At the same time, the unemployment rate dipped to the lowest level since May of 2024. The number of unemployed declined by 35,000 in January, bringing the unemployment rate down to 4%, according to the National Association of Realtors. Job growth may have come in lower than predicted because of the impacts of winter storms in the east and south, as well as the wildfires in Los Angeles. The unemployment rate fell to 4%, she explained. The biggest gains were in retail, healthcare, and professional, scientific, and technical service sectors, while job growth in the manufacturing and construction sectors were more tepid. We talked on one of my previous lives about tariffs. And one of the downsides of tariffs is that the countries that sell their goods here will often increase how much they charge you because they're being taxed by the government to sell their stuff here when they're from another country. One of the good side of tariffs is it creates incentive for Americans to make stuff here, because then the more people want to buy American because they avoid that price gouging that the company getting taxed gives them. So if we do that, you are likely to see more manufacturing and more construction happening here. And here's the point of the whole video. It's probably going to happen in the Midwest and the South, not the expensive South, not Miami, right? Not Atlanta. We're talking about the areas that have been overlooked. The Alabamas, the Arkansas, the Kansas, the Ohios, the Michigans, the Oklahomas, the Nebraskas, the areas that a lot of people have said, or Louisiana even, why would we ever go there? There's no opportunity. As manufacturing, and if it does take place, moves into those areas, expect those housing markets to be the next wave that everybody sees. I'm telling you, hear this first. Those of you that are into long distance real estate investing, like the book that I wrote, this is what you need to be paying attention to. Don't look at where everybody's already been. Those are the markets that are having a hard time. South Florida is getting crushed. The San Francisco Bay Area is not doing super hot right now. Southern California is not terrible, but they're not as hot as they were before. Austin, Texas is getting hurt. A lot of markets that previously exploded, like Maui that we talked about, are having a really hard time. A lot of other countries that we're seeing growth are also going through a period of stagnation. So what's next? People are going to move where things are cheaper. I'll let you guys put the dots together about what that actually means. All right, folks. No more new questions are coming in, so I don't think I'll keep you for a whole lot longer, but thank you guys very much for being here and following me today. Thanks for everybody that joined on the live and everyone that did submit a question. Leave a comment below. And thanks for supporting the channel. All I ask is that you subscribe to it. And if you'd like more information from me, I have a text letter that goes out every single week. All kinds of cool stuff. It's got mortgage rate changes. Like, we tell you exactly what the OneBrokerage is offering on the different rates that we have. We can get you lower rates than what you see in there, but those are like pretty conservative rates of what they have. Changes about what I'm doing, where I'm going, where I'm speaking, what I see in the economy. Interesting articles like the ones we cover on these lives. It's all free. You just get a text to your phone once a week that you click open. You can read right there. I don't use your information to spam you. I don't use your information to sell to anybody else. If you're in my world, you're safe. So all you got to do is go to davidgreen24.com/textletter. one word. You'll see a screen that looks like this. Just put in your first name, your last name, your phone number, if you want to, because we need that to give you the text letter, and your email address, because I have a different newsletter that goes out via email. That one is called Seeing Greene, and the one that goes out via the text line is called Behind the Shine, because of my old noggin here. So make sure you guys sign up for that. And remember, at the One Brokerage, we are here to finance all your real estate and make sure you don't get ripped off. So you can either message me on Instagram directly at DavidGreene24 and tell me you'd like to be put in touch with a loan officer. You can go to davidgreen24.com and you can use the chat option there to get a hold of me, and I'll put you in with someone. Or if you already have my email, send me an email and I will connect you directly. Thanks again. Keep an eye out for future lives, and let's all get through this thing together. Appreciate y'all.